Welcome back to the Deep Dive. Today, we're opening up your wallet, metaphorically, of course, and we're looking at the new ghost in the machine. We're talking about AI in finance.
And we're not talking about those, high-frequency trading bots on Wall Street.
No, not at all. I'm talking about the tools that are probably sitting in your pocket right now.
It's a massive shift. I mean, we're moving from AI as the sort of background thing, like the fraud alerts you get to AI as an active partner in how you manage your money.
And the scale of this is what really jumped out at me. I was digging into the Miami Herbert Business School study in our stack, and wow, the adoption rate is staggering.
It's huge.
They found that nearly 47% of retail investors are already using generative AI, almost half.
It is a huge number, but you have to be careful of that stat. It sort of sounds like everyone is a cyborg investor now, but the study actually points to this massive sophistication gap.
Right. It's not like everyone's using it the same way. It's not my teenage cousin and Warren Buffett asking it the same questions.
Exactly. You have these really sophisticated investors using it for complex sentiment analysis, comparing balance sheets, things that used to take days, now it takes seconds. They're basically running hedge fund strategies from home.
Okay. And on the other side,
you have a huge chunk of everyday investors who are either using it for, like, explain this stock to me like I'm 5, or they're just staying away completely. Privacy concerns, mostly.
So it's less a rising tide lifting all boats and more like a turbocharger for the people who already have the fastest cars.
That's a great way to put it. And that really sets up the mission for this deep dive. We need to figure out, is this AI a magic money tree that levels the playing field?
Or is it a black box full of, glitches and security traps that's just going to get us all into trouble?
To figure that out, we've got a really interesting stack. There's a fascinating experiment from the Ontario Securities Commission, some heavy technical papers from RxEve, and some very blunt warnings from JP Morgan.
So let's start with the big one, the question everyone wants an answer to. Does AI actually make you a better investor?
Or does it just help you lose your money with, a lot more confidence?
Exactly. And the data here is surprising. We have to look at this experiment from the Ontario Securities Commission, the OSC, and the Behavioral Insights team.
This was just a brilliant setup. It really isolates that trust variable. They gave people a hypothetical $20,000 to invest.
Okay.
And then they split them into 3 groups. Group A gets advice from a human advisor. Group B gets it from an AI.
And Group C?
Group C gets it from a blended source.
Yeah.
A human who explicitly says, I'm using AI tools to help generate this advice.
This is where my assumptions just fell apart. I thought, okay, the human wins on trust. We like looking people in the eye.
Or maybe the pure AI wins on data authority, right?
Right, but the winner was the combination.
The Cyborg one. The blended advisor. The study found investors followed the advice of that blended advisor most closely. Their portfolios deviated. I think it was 8.9% less from the suggestion than the people who just got advice from a human.
That's a huge margin in behavioral finance. So what's the psychology there? We like the high-tech processing, but we don't trust the machine to fly the plane solo.
Precisely. It suggests we want a hybrid approach. We want the confidence that a machine crunched the numbers because we know humans make math errors, but we crave that final reassurance, that stamp of approval from a person.
But there was a catch in this study. A very, very human catch that no amount of AI could fix.
Ah, yes. The cash bias.
This part, I'm so guilty of this.
We all are. It's this classic psychological quirk. The researchers found that no matter who gave the advice, human, AI, cyborg, and no matter how sound that advice was,
they still wanted to keep cash.
Yep, they had this gravitational pull toward holding about 20% of their portfolio in cash.
So even if the advisor is saying, look, the math says invest it all, the person is thinking, yeah, but I'm going to keep $4,000 under the mattress just in case.
It's called extreme aversion bias. And even in a simulation with fake money, people felt safer hoarding cash. In the real world, that creates what we call cash drag.
You're losing to inflation, missing out on growth. So the algorithm can be perfect, but the user is still buggy.
Exactly. The AI can give us the perfect strategy, but it can't easily override our basic human anxiety.
But on the trust thing, there's another finding that kind of surprised me. The study found no statistically significant difference between the AI-only and the human-only groups.
That's a huge deal.
It is.
It means that whole stigma of taking advice from a robot is just, it's fading much faster than anyone thought. People are ready to trust the algorithm.
Okay, so if we're starting to trust the machine, we need to understand what it's actually doing. It's not just a fancy calculator. Let's go under the hood. We've got this paper from Archilif about something called the LPPR framework.
This gets a little technical, but stick with me because this is really the architecture of the future. LPPR stands for Large Language Model-Based Personalized Portfolio Recommender.
That is a mouthful. Break it down. It's like two different brains working together, right?
That's a perfect way to think about it. You have the front of house and a back of house. The large language model, the LLM, that's your front of house.
The conversational part.
Exactly. It talks to you, it understands your goals, it figures out your risk tolerance through just natural language. They call this the Fin agent.
Which is a huge upgrade from the old way, filling out a form that asks, on a scale of 1 to 5, how much do you hate losing money?
Right. Those forms are terrible. The LLM builds a psychological profile based on how you actually speak. Then it hands that profile to the back of house, the reinforcement learning engine. They use a method called PPO.
And that's the math brain.
That's the engine. It
Yeah.
optimizes the investment strategy by learning through trial and error. It's basically playing the market millions of times in a simulation to find the winning path for you.
And the results from the paper, these weren't small games.
No, not at all. In their simulations, this LPPR model got a 14.63% annualized return. Now, compare that to the traditional method, mean variance optimization.
Which is what most robo-advisors use now.
Yes, that only hit 8.42%.
That is almost double the performance. But my inner skeptic is screaming. Did it just take on a ton of risk?
That's the kicker. It actually had a lower maximum drawdown, so when the market dipped, the AI portfolio lost less money than the standard one.
So it's better at playing defense and offense.
It's the best of both worlds.
Now, we should be clear. This is a simulation. Real markets are messy.
Very true. But we are seeing this kind of logic trickle down into apps people use every day, like Mint and YNAB. You need a budget. They're evolving.
Right, from here's what you spent to here's what you're about to spend.
Exactly. They use machine learning to predict your future cash flow. So it shifts your finances from being reactive, looking at the damage, to being proactive. It tells you, hey, slow down. You have a big insurance bill in 2 weeks that you forgot about.
Okay, so we've got better returns, smarter budgeting, a cyborg advisor we trust. It all sounds a little too good to be true. And this is the deep dive, so I know there's a but.
There's always a but. And in this case, it's a really deep structural one. It's about the data itself.
Right. If the AI is learning from history, well, history wasn't exactly a level playing field.
And this is the critical flaw. We've got a paper from EA Journals that dives deep into algorithmic bias. The problem is, if you train an AI on historical loan data from, say, the last 50 years, what does the AI learn?
It learns who got loans and who didn't.
Correct. And historically, you had redlining. Minority neighborhoods were systematically denied loans. The AI looks at that data and sees a pattern. It says, oh, people in these areas are a higher risk. It replicates the past because it doesn't know the history. It only knows the numbers.
But can't you just tell the AI, hey, ignore race, just delete that column from the spreadsheet?
You can, but these models are incredibly good at finding what they call proxy variables. Yeah. Take ZIP codes. Even if you remove race from the data, the AI sees that a certain ZIP code correlates with higher loan denial rates, so it just starts penalizing that ZIP code. The paper found algorithms charging Hispanic and African American borrowers higher interest rates than white borrowers with similar risk profiles, all based on these invisible proxies.
That is terrifying.
Yeah.
It really is, because it's invisible. It's just the math.
Yeah.
You can fire a biased loan officer. How do you fire a biased black box?
It's so difficult. And it's complicated by this accuracy versus fairness trap. To make an algorithm as accurate as possible for the majority, it often sacrifices fairness for minority groups.
The thin file borrowers.
Exactly. The algorithm minimizes its overall error rate, but the errors it does make fall disproportionately on specific groups of people.
So are we stuck? Is there a fix?
There are technical fixes. The paper talks about a technique called reweighing. Basically, you tell the AI during training, hey, pay more attention to this underrepresented group. You give their data more weight to balance the scales.
So you force it to acknowledge its blind spots. What about seeing why it made a decision?
That's the next frontier. There are tools with names like Lime and Eshape. Think of them like flashlights that let you peer inside the black box. They can analyze a loan denial and tell you exactly which variables tipped the scale.
So it could say, it wasn't your income, it was your debt-to-income ratio.
Precisely. And that explainability is crucial if we're going to trust these systems.
Okay, trust is one thing, but security is a whole other beast. I want to pivot to privacy, because this JP Morgan briefing we have, It's a real wake-up call.
It really is. The briefing makes a key point. When you chat with a public AI bot, you are not just searching Google. You are feeding a model. It's learning from you. It's capturing your IP address, your location, your device info.
And whatever you type in, I can just imagine someone pasting their entire tax return in there saying, find me some deductions.
And now that tax return is potentially part of the training data forever, JP Morgan's advice is blunt. If you wouldn't see it in a newspaper, don't put it in a chatbot.
That's a good rule of thumb.
But honestly, the scariest risk isn't just what you type in, it's what can be faked using your data.
You're talking about the voice cloning.
Yes, voice deepfakes. This is moving so fast. Cyber criminals can scrape audio from your social media, an Instagram story, a TikTok. They feed that into an AI, and they can clone your voice with terrifying accuracy.
So they call your grandmother, and it sounds exactly like you, panicked, saying you're in trouble and need money wired immediately.
Exactly. And because it sounds just like you, the tone, the cadence, your grandmother's natural human authentication system fails. Her ears are lying to her.
That's wow.
Which is why JP Morgan suggests a very analog solution to this very high-tech problem.
And that is
Establish a family safe word.
like a spy movie, a password.
Yes. It sounds silly, but it works. If your son calls asking for money, you ask for the safe word. If the voice on the phone doesn't know it, you hang up. It is simple and it is unhackable. It beats the AI.
That's such a solid tip. I'm literally doing that with my family tonight. But what about hackers messing with the AI at the source?
That's called data poisoning. It's a sophisticated attack where they corrupt the training data. Imagine teaching the AI that a certain fraudulent pattern is actually safe.
So they're teaching the guard dog to ignore the burglar.
Perfectly put. Or they use AI to write perfect phishing emails. You know how we used to spot scams because of the bad grammar?
Dear sir, I am Prince. Yeah, the typos were the red flag.
Gen AI fixes that. Now the phishing emails look professional, they look perfect, so privacy hygiene is critical. Use a VPN. And a great tip they had was to create a dedicated email address just for your AI accounts.
So if it gets compromised, your main banking email isn't exposed.
Exactly.
It feels like for every step forward in convenience, we take a half step back in security. So
Is anyone watching The Watchmen here? Is regulation coming?
it is, and the landscape is shifting fast. The ICMA regulatory roadmap highlights 2026 as a really pivotal year.
2026, that's right around the corner. By then, the EU AI Act will be in full force. It's huge legislation. It classifies AI based on risk, and financial AI often falls into the high-risk category. They're going to demand transparency and human oversight.
What about in the U.S.?
The U.S. is taking a slightly different approach. The SEC is focused heavily on conflicts of interest. They want to make sure that AI isn't just nudging you to buy a stock because it benefits the brokerage firm.
Preventing the AI from being a double agent.
Right. They want to ensure that fiduciary duty applies to the code, not just the human.
Which brings us back to the human element. We've got these insights from Jacob Gold at ASU, and he has an interesting take on where the human advisor fits in now.
I love his perspective. He uses that old phrase, garbage in, garbage out. The AI can run a million Monte Carlo simulations, but if the data you feed it is wrong, the answer is wrong. Humans are the quality control.
But he also says the job is shifting from finance to personal.
It's the empathy factor. The AI tells you what the numbers say. The human helps you deal with how that feels. When the market crashes, the AI just updates the charts. The human talks you off the ledge so you don't sell everything at the bottom.
So the future isn't AI replacing advisors, it's advisors using AI to stop doing the boring spreadsheet stuff so they can actually talk to their clients.
And potentially democratize that advice. Small investors now have access to tools that used to be locked inside massive institutions. It levels the playing field if you know how to use it.
So wrapping this all up, what's the big takeaway for you, the listener?
I think it's that we are truly entering the era of the blended model. We saw it in the OSC experiment. We see it in the expert predictions. The sweet spot isn't handing the keys to a robot. It's using AI for the heavy lifting, the data processing, the scenario planning, but keeping a human in the loop for judgment and, frankly, for safety.
Use the co-pilot, but don't take your hands off the wheel.
Precisely. And don't give the co-pilot your social security number.
Wise words. We've covered a lot today. The cyborg advisor, the cash bias we just can't shake, the incredible returns of these new models, and the very, very real risks of bias and deepfakes.
It's a powerful tool, but like any power tool, you can build a house with it, or you can cut your thumb off. It requires respect.
I want to leave you with one final thought to chew on. We started with that stat that 47% of retail investors are using AI. But remember, The sophistication gap. The people adopting this fastest are the ones who are already financially savvy.
Which raises a really provocative question. Will this technology actually democratize finance like we all hope, or will it just be a force multiplier for the people who are already winning? Are we creating a future where the wealth gap is defined not just by how much money you have, but by how good your AI is?
Something to think about next time you ask a chatbot for a stock tip. Thanks for taking the deep dive with us.
See you next time.